Chris Neary. I'm the acquisitions associate at passiveinvesting.com. That was Eric Fitzgerald speaking there. He is the director of acquisitions. Today we're going to be talking about multifamily and build-to-rent single-family better together. Here are some of the topics that we're going to touch upon, as well as our headshots, our great headshots right here. So we'll get into nitty-gritty as we go forward, but first I want to promote Multifamily Investor Nation. We have a 3-day live online event coming this January 20th to the 22nd. We have tickets right here. We will post a link in the chat box to this page here, and you can scroll through it and see all the great speakers. We have our 3 managing partners at passiveinvesting.com speaking, as well as a plethora of other great real estate professionals in the industry. So definitely check that out. I'm sure you'll see some familiar faces. It is definitely worth the experience and knowledge. So please go ahead and check that out. And I will show passiveinvesting.com, our webpage right here. We have a couple tabs at the top. First is Meet the Team. So here are partners again. You can click on them, and some of us have a video of just explaining who we are and what we do for the company. We've had a lot of hire-ons this past couple of months, so you can see those. You'll see some familiar faces and some new faces. So definitely check us out. Here's Eric, and I am right here. And we have our self-storage guys right here, as well as the Rehab Wallet real estate debt fund as well, which is a hard money lending. So definitely check out everyone. So yeah, from there we can jump on in it. I'll let Eric start us out here.
Yeah. So I guess we're talking about build to rent here, and obviously that's a kind of a sector of multifamily. We look at, as an acquisitions team, hundreds of deals a year. And obviously that means that we underwrite a lot of deals, and the vast majority of that is your kind of garden style or mid-rise type of multifamily asset. But what we've been seeing recently, I would say over the last probably 6 months, is an increased deal flow and increased kind of chatter about this build to rent space. So it's something that is relatively new to us. We have pursued more than a few build to rent properties this year. But the reality of being in acquisitions is that you deal with no's a lot. And so, we haven't been able to actually acquire one yet. That's definitely one of our goals in 2022, is to actually lock one up. A lot of times with these properties, sometimes you'll see they're offering it as a pre-stabilization type of asset, where it's not actually fully built yet or fully leased up, but they're actually kind of selling it on a pre-stabilized basis. We actually prefer that, because that means we go in, our property management company is very good at lease up. So maybe we even finish the lease up and we're able to kind of see those lease trade outs. Maybe they're offering concessions and lower rents on the first, couple months of leases. But as we actually take over that property over the first 12 months, we're able to roll over all those leases and take advantage of that rent growth that limited supply does to a property. So we're actually able to raise those rents up to the market level for the whole property. And that's kind of a value add without actually going in and ripping apart, cabinets and countertops and all that fun stuff. So you will see kind of the build to rent space a lot of times will be pre-stabilized. We have underwrote a couple that have been recently stabilized. I will say there is a premium to be paid for this type of product in terms of, the price per unit. A lot of times, especially in the major MSAs, in Florida and the Carolinas that we look at, a lot of times those properties are touching the $400,000 per unit threshold. But, that's definitely sticker shock a little bit when you first look at it. But you have to also look at the rents. A lot of times those rents are at 3,000 or 2,500, depending on the MSA. So the cap rates kind of start to make sense compared to your traditional multifamily. So I know there's a point in there that says, why is multifamily such a great investment? I don't know that we have to go super into detail on that. I mean, everybody here is, I think, familiar with multifamily. We purchased over $500 million as a team in multifamily just this year. So we're definitely big fans of multifamily and would not be buying that much if it were not a great investment in our eyes. So I think, housing demand, the returns are there, especially in the Southeast where we're kind of based out of. There was a chart on LinkedIn that was kind of making the rounds, and I don't actually have it on hand, but it kind of showed the population shifting from places like the West in California, the Midwest, the Northeast. Chris and I are both from the Northeast, and we're both in the Carolinas now, so we're just a small sample size of kind of what is happening in the greater kind of population of America. So we're very bullish on the Southeast and Texas, and that's where the majority of our assets are based out of, actually all of our assets. So that's just kind of touching on multifamily a little bit, but Chris, do you want to kind of touch on anything there? I know I spoke for a little while there, so I want to see if you had any comments there.
Yeah, absolutely. I'm actually going to dial it back a little bit just for the audience here. If you don't know what build-to-rent is, it's also referred to as BTR. That's just the acronym, as well as single-family rentals or single-family build-to-rent, or SFBR. That's just some of the real estate terminology. It is a community, just as multifamily. It's a large plot of land where there's multiple single-family detached homes that are built on that single parcel of land. A lot of times it is that one parcel, but they can be sectioned off as well. So there's one developer, one owner, and then they will rent out that community of homes to a tenant based. So as Eric said, obviously there has been a huge uptick this past year, but this is actually not a new concept. It just hasn't been so prominent as it has been. And just to give you an idea of the size of it, 6% of homes, of new single-family homes in America are build-to-rent communities. So based on some research, based on a lot of the economists and people in the industry, that number is expected to rise. And I think it is very important for not only our company, but for the mass population to know what these build-to-rent communities are and what they will play within the sector. I think Eric touched upon multifamily. I don't think we need to get further into that. But again, if you do have questions, you can write in that chat box or question and answer section. But to build upon why is build-to-rent the wave of the future, I don't see build-to-rent being a replacement for multifamily communities, your urban, your mid-rise, your garden style. I think it's definitely a supplement to the existing deals out there. And it's really for the millennials that have young kids that are really not wanting to take on a mortgage at this time. As everyone knows, the market, especially the single family market, has been booming the past year or so in the pandemic, and just breaking into it for your own family is quite difficult. Therefore, your mortgage, it's higher values, therefore your mortgage payment's going to be a little bit higher. So this, I don't want to say, I think the build-to-rent communities on average are lower than a mortgage payment, and it's obviously less of a headache if you need to get out and move out. A lot of these leases are a year long, whereas if you buy a home, you have to go through the headache of closing and selling that property. So a lot of these families that want a 2-car garage, a yard for their dog, kids to run around in a small suburban area, this is a great complement to that pre-existing multifamily assets. So yeah, that's why we're seeing a lot of these deals, a lot of these communities popping up in the Southeast and Colorado, out west a little bit as well, just because there is the land to support the size of these communities. And you'll see a lot of them are a little bit outside the MSA of these larger markets, including Savannah, Florida. You'll see them in Melbourne and Palm Bay. And I actually have a map here of just some of the deals that we have seen of where exactly these deals are popping up. So we're seeing them, obviously this is our target markets is the Southeast, but we're seeing them outside of Atlanta, scrolls quick, outside of Savannah, some are coming in Florida. So just to touch upon, I think this is what are the best build-to-rent strategies and locations. So a lot of them are coming in the markets that we're looking at, and of course we're transitioning and jumping on that train, as Eric mentioned. So, yeah. Eric, would you like to build upon that, or?
Yeah, I mean, if you think about it, even from a conceptual standpoint, like what are the advantages of a build-to-rent asset? I have two separate sets of aunts and uncles that moved from up north down to the Carolinas, actually in the Wilmington area where we just closed an asset in. And they're not, so they're getting older. They're not kind of interested in the home maintenance type of situation, but they're also, they have a dog. They want a little more space for when, their kids come to visit from college or whatever. So they actually went to build-to-rent places when they first kind of moved down there. So I think it makes sense as you kind of see that migration coming from some of the northern areas. And even the property that we just closed in Wilmington was kind of your carriage home style. So it was a two-car garage below, and then the apartment up top. So every apartment had a two-car garage. So that kind of gives you a little bit more of a home feel. So it certainly kind of hits on the needs of the specific tenant base. Of course, that varies by market and sub-market, but generally that's what people are looking for. So certainly a good story there. I see a question about, are HOAs prevalent in the build-to-rents? If so, how would those affect the investments in build-to-rents? Yes, there usually is some kind of HOA. Usually in the financial documents, there will be the HOA document where it'll show you kind of what the costs are for your specific, plot of land and your specific LLC. That'll also be included in the property's historical financials. So kind of, analyze to see if maybe they're putting some of those HOA expenses that should be kind of all in one bucket. Maybe they're putting it in maintenance or contract services, and just kind of making sure you're really digging into what does the HOA actually cost us per year. And of course, the contract will tell you that, but just kind of digging a little bit into the maintenance and the contract services just to make sure all those costs are actually accounted for in the trailing financials. So you have an accurate pro forma moving forward.
I can build upon that too. So an HOA is usually covering, your contract services, so your landscape, your pool contract, your XYZ elevator contract, and typically in a T12 or trailing 12 expenses, you'll see those expenses regardless. It's just within an HOA, it's bundling that all together. So it's not really making a difference in the expense by a large amount, if anything at all. So that's just something, it might be a little bit harder to gauge exactly how much everything costs, but it's definitely not a make or break for returns on a property. And there's some other questions coming in here as well. I think Irish Kevin wrote, why would BTR be better for sponsor versus multifamily? More roofs, larger lots, properties spread out. So I think, yes, there are more roofs. There are properties are spread out, but that is why we do have that HOA. And sometimes in some communities, you can just as there are rubs or rebills for utilities, you can charge a flat or fixed rate fee for an HOA expense to your tenants. So that I don't think that by any means is affecting our returns in a large amount that we would pass on deals, but it is something to be aware of, right? There is definitely more roofs and larger maintenance within the property, but those are things that we're aware of going into. Eric, I think if you want to build upon that.
Yeah. So a lot of times these properties are newer, so the maintenance is not as much of a concern as like buying a 1970s multifamily would be in terms of the larger CapEx stuff. We do underwrite for higher maintenance for these types of properties, but typically you're going to be lower than even a 1970s garden multifamily CapEx budget would be because a lot of these properties are newer. As far as why would it be better for the sponsor, we certainly obviously still love regular multifamily and still look to acquire a lot of that. As far as this specific subsector of multifamily, I think you have a little bit more of a sticky tenant base with this type of product. So maybe it's a family or like my aunt and uncles that are moving down, probably a little bit more long-term of a tenant. And you certainly do get higher rents per square foot with, usually they have garages attached. So that's, $150 to $200 premium on a regular apartment. So typically that just gets baked into the rent. But, as far as, I saw cap rates being mentioned in there, they're pretty comparable with multifamily. So if you're able to get a great product, a great build-to-rent product for a similar cap rate to what a garden multifamily would be, I would think you're at a good spot in terms of what you're paying for, in terms of what product you're actually buying. Because I do believe that this type of tenant base is a little bit stickier in terms of how long they stay. So that's another reason why we like the build-to-rent.
Yeah, and the other part of that question is, will they be tougher to sell, or does it depend on the cap rate? So, with build-to-rent communities, there's actually more options going forward with a sale. So you can actually sell it as a complete community as it was bought up front, or you can actually parcel them off. You can sell them a home one by one. So you actually have more options, and therefore it might be less of a risk, depending on how you view that. But that's a beauty of build-to-rent. You can sell them as a single-family home, or you can sell them, as an entire community as it was bought, which is definitely something we think about as we analyze these deals.
See a question in here on what is a good gauge on if it's a good deal or not. Cash flow minimums, cash on cash. The answer to questions like these is always going to be, it depends. But as far as for our kind of parameters, we always look for a 7% at the very least cash on cash. So we pay our investors, our Class B investors, a 7% preferred return in participation in the upside, and the Class A gets a 9% preferred return with no participation in the upside. And you can blend your investments between those two classes depending on your goals as a passive investor. So we always look for 7% in this market. That is becoming increasingly, kind of hard to find, and we're kind of running into that as that's how we tap out on deals, is our cash return. So that's kind of a little bit of our kind of cash flow projections and that's on build-to-rent and general multifamily. Sometimes in year one, if it's a pre-stabilized offering, you're going to be lower on your cash, so maybe like a 5 in year one. But then as you kind of turn those leases over, get the property fully occupied, you're able to kind of hit 7, 8, 9% along the hold. As far as set CapEx, there is no one size fits all. It's all, you got to get boots on the ground on the property, see what actually needs to be done. I mean, we have our lender required reserves is $250 per unit generally, but we always have a separate kind of CapEx item. Now, again, a lot of times these properties are newer, so we're not going in and, like I said, replacing cabinets or doing any type of value add, but as far as CapEx goes, it's kind of a case-by-case type of basis.
Yep. Great. I think another question that came in here is how to find out the rent comps for build to rent in a zip code. Well, there's many ways a simple Google search of just apartments.com, LoopNet. We use a service called CoStar that helps us find our comparable assets within a specific submarket or market. So there's many ways to approach that. Even just going out and knocking on doors or knocking on communities and just asking what they're charging, or giving them a phone call. So that's a couple ways that we go about it. I'd like to touch upon a topic that we have not spoken about, I believe, is what are the best multifamily asset classes. And a lot of these build-to-rents, I think that's obviously an opinion-based question. It depends on what you're looking for. Here at PassiveInvesting.com, we focus on B plus, A, and A plus communities or assets, and we find that these are a little bit less riskier compared to your lower Bs, your C class deals, where there might be a lot of upside with value add, but then again you might have to re-tenant or refill this entire property with a new tenant base. So I think that is definitely a hard question to answer, but for our specific case, we find for our investors that the best classes are the newer assets in the larger MSA markets within the Southeast. Eric, I think Eric has worked on the Class C properties as well, so he might have a little bit better insight with that question.
What was the question?
Sorry. So what are the best multifamily asset classes?
Oh yeah, Class A for sure. Class A and B, obviously it's opinion based, like Chris said. But I have been in the Class C space, and it's a lot more headaches. I don't think you're getting enough of a premium on the premium would be the opposite word, a discount on the price you're paying for Class C versus Class A. Cap rates are very similar between those two assets, and I just think the risk involved in your lower Class C with lower income tenants and just the capex tsunami that is basically kind of the 1970s properties getting really old by this point, and just the major systems needing replacing and all that kind of stuff. I don't think the market is granting enough of a discount for people that are willing to go in and do all that work. If things change, we will be certainly open to investing in Class C apartments if the pricing makes sense and the strategy makes sense for us. But with cap rates pretty much equal across the Class C to Class A space, we prefer to buy Class A in strong markets. So that's kind of our opinion there. I see a question about how does public storage compare with multifamily and build-to-rent. So Chris and I are strictly multifamily. So we do have two managing partners, John and Chris, who oversee the self-storage space. So unfortunately, I will not be of any help there. I know there's a fund with the self-storage. So it's kind of a different depending on your goals as an investor. And we do have on our website there that Chris is going on to more detail about the fund and what kind of returns you can expect, what kind of timelines you can expect. So plenty of information there. I don't want to speak too much about something I don't know a whole lot about, so I'll just stick to multifamily. But we certainly have a lot of resources there in terms of getting educated on what our self-storage investments look like. And I know they're doing very well this year, so certainly worth checking that out. Let's see, if this is a newer concept, I think deal flow would be minimal until more of these developments get built out and then traded later. Yeah, that's correct. So we have seen deal flow pick up over the last probably 6 months. Before then, there were not a whole lot, but I mean, in our pipeline right now, we have 2 or 3 of these kind of pre-stabilized build-to-rent communities. There's more institutional interest. Companies that we have bought multifamily from are developing build-to-rent communities now along with their multifamily. So certainly true that deal flow is a little bit smaller now, but definitely growing.
And if you do research on your own, if you just do a quick Google search, you can find some articles that there's some pretty prominent people in the space that talk about the expected growth and the anticipation of what's to come within the build to rent. And there's a lot of information. There's abundance of information on the topic, and I highly encourage it because I think we'll continue to see this not only in 2022 and this year, but in the years to come. So we're going to answer some more questions here. What is the overall return to investors? Equity multiple. I think Eric touched on our criteria for our investors. We have a 7% preferred return, but that just depends on who you're dealing with, whether that's in a syndication group or a REIT or whatever it may be. But we have a standard, and of course, if we don't hit those target numbers, we will not pursue a deal. Let's see if there's other ones coming in here. There's a few coming in the question and answer chat box. When selling off BTR upfront or pad by pad, are buyers paying the future ARV or the new construction or just a negotiated price of the future cash flow? It's a good question.
It's usually based on the future cash flow. They're not usually selling them off in terms of like what a single family home would go for on the kind of residential market. It's always going to be on discounted cash flow analysis based on the income that the property is going to bring in. So I understand the question. It's not kind of your residential. What would this property go for if Sally and Jim and their 2 kids were buying it for the school district? It's more of what can I pay for this based on the returns I need to present to my investors and achieve for my investors. So that's a good question. I think if we answered that correctly.
From the same gentleman, Brandon, have you seen trend of BTR in rural areas? Also, what minimum units for the community? I don't think there's a minimum. We've seen some communities that have come in the 60 to 80 units, all the way up to 300 plus units. So, and yes, we have seen them in the rural areas. They're definitely in the suburbs of these larger markets where there, of course, is more land and people want to be 15, 20, 30 minutes outside of the major cities, so they can have that yard and so they can have their dog running around and their young kids and be in the great school districts. So yes, we are seeing that. Not all of them are super, in the middle of nowhere, but there have been some deals that have come up where it's like, where is this place? Maybe they see where this up and coming submarket's coming, but we're definitely seeing them pop up all over the place. Will you do new development in the BTR space? Eric?
Stephen, if you're a developer and you know what you're doing with BuildtoRent, we would be glad to work with you. It's something that we're definitely open to. It's something that we've kind of discussed, but we're focused on kind of acquiring existing assets or pre-stabilized assets at this time. And this kind of goes into Marty's question about, do you see an opportunity for a builder to finish a build out, then to flip to an investor? There's a lot of opportunities in this build-to-rent development space right now. Like I said, a lot of the large multifamily nationwide developers that we've purchased from in the past are now creating whole business lines for build-to-rent development. And so there's a lot of opportunity there. We would love to do new development in the build-to-rent space, just not something that we've been able to kind of kickstart yet. And on Marty's question, definitely opportunity for, there's tons of, I think Brandon was at a panel and I forget what the conference was, but he was on a panel at a conference and there were 5 or 6 heads of very large, commercial real estate investment firms, and all of them were talking about kind of build-to-rent and their interest in build-to-rent. So there's a lot of capital coming for the build-to-rent space, and I think that's obviously a good opportunity for developers and people that know what they're doing in that space.
Yeah, and there wouldn't be a supply if there wasn't a demand and returns on their capital invested within these developments. So obviously there's good money to be made within these communities, and obviously there is a demand for people to live in these communities. So and just to build upon why it's so strong nowadays, I think the pandemic might have played a small part of just exposing this real estate option, because a lot of people are working from home. Eric and myself actually work remotely, as does our whole team, and that has been a trend within the United States where a lot of people need an extra room or two, and these communities supply that. They're the perfect option for that need. So I don't think remote work is going anywhere, and that's a discussion for a whole nother webinar, but I think this is going to be a long-lasting effect within the real estate industry, and we can already see it going just straight upwards. So for exactly the reason we're having a webinar here today about it. I think there's some other questions rolling in here. Brandon, you wrote in the question and answer box, it's a little bit more specific. I think if Eric, you want to take a crack at that, or we can reach out, if you want to reach out to us separately.
Is it realistic for investors that own the land and bring equity, but want to bring in capital partners to receive 80-20 split with capital partners 20 to 30%, or do they want more as minimum? So we have not kind of ironed out what exactly a split would look like if we were to partner with, say, a developer and kind of buy them out at the end, or stay with them as kind of partners. So, I mean, eventually it's all going to come down to what return does the capital partner need on whatever capital they're bringing. So I would say the split, you might be able to back into the split by calculating what is the amount that they're investing, what are the returns, and what split of those returns do they need to hit whatever their return parameters are. But I apologize, we don't have kind of a better answer to that question. We just haven't hammered that out for ourselves and for our investors yet. So we just don't have firsthand knowledge as to what kind of split there would need to be.
So last one here, what are the preferred locations for BTR? I think we've touched upon this. For our specific company, it's the Southeast, where we focus all of our efforts. But I don't think it's limited to that. I'm not sure exactly how prominent they've become in the Northeast or just the North in general, but these communities are really popping up everywhere you can look in the South. So I've highlighted, I can share this map again. So this is where we've seen deals pop up. Sorry, my scroll is a bit sensitive. So, Tennessee, that North Carolina, South Carolina border, Myrtle Beach, Atlanta area, Savannah. We've seen some come up in the coast of Florida. And I really don't think it's limited to that. We've seen a couple deals that maybe we haven't spent so much time on in Colorado. But you can expect to see them pop up everywhere you look, in my opinion. I hope that answers your question there. I believe we touched everything that we set out to answer. So if there's any last questions, you can definitely reach out to Eric or myself. Our information is on the website. And please check out the link provided in the chat on the Multifamily Investor Nation. It is coming up quick. So please get your tickets now. And if you have any questions, like I said, feel free to reach us out. Eric, any last words?
No, that was it. I hope this was helpful. And stay tuned for next week's webinar.
Yes, Tuesday. All right. Thanks to everyone.
All right. Thanks, guys.